When you think of some of the most interesting people in the world, you obviously think associated with Walmart or Reddit. And today we're going to be going over Reddit Dividend Portfolios. These are a mix of portfolios, and I'm going to be sharing my honest, unfiltered thoughts on them. This is a series that I've been looking to do for a while now. If you enjoy this kind of content, let me know in the comments section, and smash that like button for me also. It's a really great indicator of whether you guys actually like this stuff or not. I mean, what is there not to like about some guy who's in retirement putting their entire portfolio in YieldMax ETFs? There's nothing not to love about that. Also, make sure to check out the Do Dividend Stocks Not Drugs merchandise, of course, for the best looking merchandise for any dividend investor you know, or yourself. Some really nice new winter beanies on there, so if you're ever homeless, you put all your money into YieldMax funds, you can always wear them to stay warm. Thank you, and of course, roll the intro.
Hello, I like money.
Alright, to start off, we got Personal Occasion 618, and he asks, what do we think of the portfolio? Some of these are in undervalued stocks, some of them are in mega cap tech, and some of them are in ETF and dividend stocks. To start off, he has $18 in CLF, $60 in JEPI, $20 in Coca-Cola, $13 in Meta, $22 in Glad, only $11 on Microsoft. I'd like to see a lot more Microsoft in there, $11 in JEPQ, $50 in Apple, which I can respect, $109 in VU, which is of course the right way to go, $41 in VYM, $10 in SCHD, $10 in SCHB, $14 in VTI, $26 in QQQ, $34 in SPY. The big issue here is he's really buying the same thing but in just different ETFs and companies. Like VYM and SCHD are pretty much the same thing, same with VTI and SPY. So I mean, I would really just kind of consolidate this. $38 into Amazon, which I think is a solid holding for sure, $15 in Bank of America, $10 into Nike, $16 into Discover Financial Services, $10 in General Motors, $10 in Nvidia, $126 in CVS, that's probably the biggest position in the portfolio, $10 in YUMC, $25 in PDD, $15 in Ford, and $23 in KMX. Alright, so personally in the first place, I would prefer this to be in percentages, but it's okay that he uses dollars. It's obviously not a giant portfolio, and maybe he's starting out investing. I would definitely say just find, consolidate the companies. There's just a whole lot of companies that I don't very view as really high quality and just kind of random, kind of like Ford. And there's also a lot of stocks that I don't really see a long-term, great growth horizon. So if I were him, I would definitely sell off the maybe SCHD or VYM. I'd compare both of them, do a more in-depth kind of analysis on both of them. Pick one of them. The same goes with VU or VTI. Consolidate those. There's a lot of the same companies here that just have different names on them, so there's just unneeded diversification. Charlie Munger would call it diversification. There's also a lot of stocks and a lot of businesses on here that I think are really small holdings but really high quality, and I think he should just pick, a few ETFs, get those really high quality companies, sell out of the garbage ones like Ford, and really just consolidate into there. Like Nvidia, Microsoft, there should be no reason that there's $10 in them. So if I were him, I'd pick an ETF or two, consolidate, and maybe find your 3, 4, or 5 highest quality companies and just continue buying into them. Don't be putting $5 into one stock, then $5 into another, and doing diversification. So I would definitely recommend consolidating his portfolio and finding the highest quality holdings. I would also recommend selling out of JEPI and JEPQ. Yes, it is nice month after month seeing that large dividend check come in, but over time you'll just get a better total return with SPY. Next we got Double D's. We got a dividend dude coming in here, and he's keeping it simple. This is probably the best portfolio here. In my 30s, 100% VTI. The most respectable one here, and I can 100% agree with this, and there's nothing he should be changing. Truthfully, that's the best portfolio I've ever seen in my life. Alright, the next one is definitely an interesting one. It comes from X Cable. He has 50% of his portfolio in APLY and 50% of his portfolio in AMZY. He reinvests those dividends back into his regular brokerage account. Now, me personally, I would not do this. One, first of all, taxes. That's a big thing there. If you were to just do regular quote-unquote dividend-focused investing and reinvest those dividends back by investing in actual companies, you'd have much better tax obligations. Basically, if you invested in regular stocks, you'd have qualified dividends, which are much more favorable tax-wise than non-qualified dividends, which are all the YieldMax funds. But overall, I do not like this whatsoever. I think there are much better ways to go about this. Just because a company has a high dividend yield, here's my issue. There's a common misconception by a lot of people that dividends are free money. Dividends are not free money. They are part of your total returns. So at the end of the day, if you compare one of these YieldMax funds with a 70% dividend yield or whatever, compare it to the S&P 500 in terms of total return, you would have had more money at the end of the day investing in the S&P 500. Dividends, you can make a homemade dividend, you can even make that argument as well, and you're getting the same amount of money and more favorable tax-wise if you're holding it long term. Here's my issue here. You can see over the last 1 year, total return, including the insane dividend yield that they have, they're only up 10.82% when it comes to total return. But if you would have put the money in the S&P 500 or SPY, which is what most Americans invest in, you would have a 23.59% return. That is over double your investment that you'd be making back. It's absolutely wild how mind-boggled some of these YieldMax investors are. Now imagine if you would have put $100, you'd only get $10 back, but if you would have $100 down, you get $23 back. This guy would have had more money to put back into his own account if he would have just kept it simple and do what most Americans do in their Roth IRA or 401k, which is buy the S&P 500. And lastly, we have All the Fields 333, and he says he's 27 years old, $75 he's putting into his account every week, which is very solid. Anybody pretty young putting money into their account, it's very good. Obviously a positive thing to look at. Now looking at building a portfolio for the long term, 10 to 20 years. Now, you can consider that long term, in my opinion. I think long term is more like 30, 40, 50, 60 years, but we have different time horizons. That is considered long term for him. And short term, 1 to 3 years. Looking at 60 to 70% growth ETFs in his long term and 40 to 30% value ETFs in the short term. So in my opinion, if I were him, he's obviously probably looking for some short term money. Now, it's a little scattered here. It looks like he wants to have most of his money being like long-term investments, obviously ETFs and all that good stuff, but he also wants to have some short-term, more speculative value plays. Overall, me personally, I'd rather just focus in on the long-term strategy and just kind of ignore that value short-term thing. A lot of times chasing value will get you burned unless it has some quality in there, like Target, wink wink. He's still relatively young, so I think he should focus on the long-term compounding portfolio. And what's to say there's not a great compounder company like Visa that goes on like some 20% dip or we go into a recession? That would just be an amazing time to buy even more long-term stocks that he's looking for in those growth things. Now, he said he wants to rebalance and reinvest any short-term investments that did well and whatnot. Now, I don't think that's the greatest way to go. First of all, obviously tax-wise, he's going to get kind of burned on that if he's going short-term. I think long-term, especially if he's 27. In his growth portfolio, he is holding SCHD and SCHD, which I think is solid. Obviously, I'd assume that with the SCHD dividend, he may be looking to live off of that eventually or use it for some expenses. He wants to go and look at some heavy tech exposure, which I think is a solid move to go if you're long-term growth focused, with VTI and QQQM, which is the Invesco NASDAQ 100 ETF. Which I think is a solid way to go if you're looking for more growth. He also has plans to go to the international market, but I'm basically building my portfolio one stock every week or so. So my investment strategy is $75 a week. So I would avoid the diversification trap or diversification as I mentioned. You don't want to obviously look to be buying a new stock every week unless it's been on your watch list or radar and you have a really strong thesis on it as a business long term. I don't plan to just build a portfolio. I am going step by step, one pick at a time, and then addressing the board until I have 10 to 15 items I like. Does it make sense to have growth long term or vice versa? So I think as a newer investor, there's obviously a lot of excitement in the air. How could you not be? And I was in this position once in my life too, where I just wanted to buy a new stock like every week. I thought that would be diversifying my wealth, all that good stuff. But at the end of the day, it's kind of the vice versa. I like his way that he wants to go through QQQM and have a lot of growth exposure and some solid ETFs. And I think that's honestly going to be the way to go. But I would avoid picking and nitpicking stocks every week and forcing yourself to buy a new stock every week just for diversification or building your portfolio. At the end of the day, don't get too excited. Stocks are just numbers on a piece of paper. But I would definitely recommend continue investing in those ETFs, getting a solid growth like SHD, QQQM, SCHG, and more. And overall, have some solid diversification, but don't buy a stock just to buy a new stock. Investing is an exciting process and an exciting time, especially when you start, but do not let that burn you. Alright, I want to thank you all so much for making the video. If you like this kind of content, you like me going over people's portfolios and lifestyles on Reddit, let me know in the comments. Hit that like button, I'd greatly appreciate it. Also, if you want to help support the channel, check out the merchandise, the links in the description. Also, if you want to use my investing software, the best investing software on the market, use dividenddata.com and use my link, it is in the description. Thank you all for watching, smash the like button, subscribe, and do dividend stocks, not drugs. Have a good one.